As of late, I've been putting out more educational content and less content about individual stock picks. And this is for a reason. I believe that we're in a time where it's going to be very important for you to be well educated on market conditions, portfolio management, and the stock market in general. Today, we're going to take a look at famous investor Peter Lynch, specifically one of his speeches from 1994 where he talked about how retail investors like you and I can win in the market. And everything he speaks about in that speech is still relevant almost 30 years later.
That the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly.
Many new investors don't know this, but the battle against hedge funds has been going on for a very long time. In the early 90s, people felt hopeless against big fund managers and their sophisticated algorithms. Well, not much has changed, has it? Now, one thing Peter really has a problem with is when people believe they can't outperform the market. I believe that is simply not true. Whenever the media and influencers say retail can't win, it causes investors to act accordingly. It's like a self-fulfilling prophecy, if you will. It makes sense. If you have no chance at winning or beating the market, why spend any time researching or educating yourself on investing? This leads to people doing irresponsible things in the market. YOLO call options, for example. Peter mentions that people need to change the way they think about big money a little. Individual investors have special advantages over funds that allow them to get in good stocks early. This is where institutions can make a huge difference. When a stock that you believe has great fundamentals is at an all-time low, all it takes is one fund to realize that, and the next thing you know, the stock is off to the races. And to the point of getting into good stocks early, this is why I focus my channel and my investing style on trying to find those really great companies within, it's pretty much a needle in a haystack, right? Because there are so many bad companies out there. There are a lot of startups that will fail. However, just like anything else in the entire world, any skill is learnable. Any skill is teachable, right? So why would it be any different in the stock market? This is not rocket science. This is actually pretty easy once you get the hang of it. And regardless of how you look in the short term, and I think this is a big thing, because small cap stocks and high growth stocks, they're very volatile by nature. And that doesn't necessarily equate to you having made a bad decision. So just assuming that all penny stocks are scams or garbage, or someone who invested in them is a terrible investor or is stupid or whatnot, that is just not the right way to be approaching things at all. You need an edge to make money. People have all sorts of edges and they don't take advantage of them. Make simple investment choices. And guys, if you could take a moment to just slap that like button real gently, please, that would be truly really helpful with the YouTube algorithm. The workers at Chrysler saw dealerships packed for years after the introduction of the minivan. If they would have invested in them a year after the minivan came out, they could have made 7x their money. The workers at Chrysler didn't need to buy 20 stocks and be diversified. The winner was right in front of them. People in specific industries have an advantage over anyone who isn't. It's sort of common sense if you really think about it. Remember this tip and remember to keep your eyes open. The next time you notice a store has lines backed out of the doors, make a note of that. Look up their stock. Go to a few more of their stores. This is one of the best ways to invest and an advantage that you truly have over any fund. If you notice a trend, if you notice an upcoming technology that is taking over and you're on the ground floor of that, it doesn't matter if the mainstream's not there yet. If you know it's happening, then you have knowledge that others don't. Peter gives a great example of this with Dunkin' Donuts. Dunkin' Donuts is a simple enough company to understand, yet he 15x'd his original investment. He was able to review the fundamentals of the company and truly understand the business model and the potential that it had. It was a simple business and an easy, stress-free investment. Now, what is easier to understand, Domino's or Qualcomm? Well, Domino's is up 1,000% over the past 10 years versus 150% for Qualcomm. They may not be a tech company, but it doesn't mean that they don't have extreme growth potential. We tend to overlook the things that we do understand and gravitate towards things that we don't necessarily understand. And things we don't truly understand always seem so much better. The grass is always greener on the other side, right? While you are going through your investing career, be sure not to step over dollars to pick up pennies. Now, you've all heard the saying, you gotta do your own due diligence and you gotta understand and completely know what you own. If you're looking to join an awesome stock and crypto community, be sure to check out our Smart Money Patreon. You're gonna get the alerts that you need to gain an edge in the market. Early stage exponential ROI projects like these will be called out so you can get in before everyone else. So if you're interested in that, the link to sign up for the private Discord and Patreon is in the description, so be sure to check that out.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason.
It turns out Peter warned us about this all the way back in 1994. He says it's utterly irresponsible to invest in stocks you know nothing about. I could not agree more with this advice. If you truly understand your investment, you should be able to break down why you like it in 2 minutes or less. And you should be completely comfortable explaining the business model. And why is this also important? Now, if you don't truly know your company inside out, what's going to happen if the price goes down? And that's a rhetorical question. Let's just say you buy a company for $2 a share without doing any due diligence whatsoever. Then the stock goes down to 60 cents. How do you feel? Would you feel happy to buy more of that stock? Or would you get scared that you are going to lose more money and sell out? The answer is you would be scared. And you should be. You know nothing about the company and you lost tons of money. It's a very bad thing.
But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
Peter's point is, if you truly understand your company and their goal, price action doesn't mean much to you. If you believe a $2 company will be worth $5 in 3 years, you will be thrilled when the price goes down. This education and due diligence allows you to invest out of a position of power. The fact of the matter is, there is a reason stocks go up. That reason is fundamentals. People want to invest in a company that makes money. If your stock doesn't have a future where they deliver profits to their shareholders, you are investing in a fairy tale. Having a long-term mindset and having patience is so critical.
My best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day. So you have to understand that and stay with it.
The long game is much easier than playing short positions. Anybody can do it and anybody can learn how to do it. Lynch says that his best stock returns have always come from companies that he has held for multiple years, not multiple months, not multiple weeks, and definitely not multiple days like some people are looking for today. Now, I'm all for taking advantage of any opportunity, which is why I also keep a portion of my portfolio for trading, for swing trading and for day trading. Because holding for years isn't always best. But if you do find a great growth company very early on, you should be prepared to be in for the long term. The problem is people get confused about what they are trying to do and what their actual goal is and what their level of comfort is. They start off with aspirations of being an investor and end up pretending to be a fortune teller.
And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires.
And he's exactly right. Nobody can predict the market. Peter mentions that out of 93 years, there were 53 years with a decline in the market, and 15 of those years saw a 25% plus decline. That means every 6 years saw a decline of 25%. Now, how would you feel if the market dropped 25% tomorrow in 2021? Would you panic as you saw your portfolio drop? Or would you be excited to buy more shares of the companies in your portfolio? Now, the market in 2021 could go in many different directions. I'm not going to sit here and tell you which direction it's going to go because I don't know, and neither does anyone else. However, make sure that your portfolio and your mindset is prepared for any ups and downs that will come.
You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific, 6 to 22 is exceptional.
I thought it was very ironic whenever Lynch started talking about hedge funds, shorts, and how they pick their targets and operate. He mentions that people often think, if the stock has gone down from $50 to $2, how much could I actually lose? His answer is that you can lose 100%. Price means nothing. Short sellers don't short companies with strong fundamentals like Johnson & Johnson and Coca-Cola. They are targeting beat-down companies who have gone from $40 to $10. Sometimes a fall from grace is for a reason. Our experiences with GameStop and AMC fall in line with exactly this. As you can see from their 10-year charts, these companies were on a downfall for years. Why are these companies so heavily shorted? GameStop has been fighting a losing battle against advances in technology and cloud gaming services. Their fundamentals have been taking a hit, and it's sort of simple to see why they were picked on. AMC is facing similar issues. Technological advances have given people great home entertainment, and the pandemic sparked companies trying out the straight-to-streaming methods. Peter was spot on detailing the type of companies that funds short. But even he would be surprised by the surge brought on by the retail investors. I am a big supporter of this movement against hedge funds and against big money. However, I also think it's smart to remind people that behind these stocks are real companies.
Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time.
To wrap it up, Lynch goes over that investing is something that takes skill and practice. If you miss an opportunity, it's not the stock's fault.
One rule you want to remember is the stock does not know you own it. This is a breakthrough.
The stock market can be an amazing tool for building wealth whenever used correctly and whenever prepared. For the rest of 2021, make sure that you are prepared and make sure that you're thinking about these important topics discussed by Lynch and invest accordingly. Thanks for watching. Like and subscribe for more content like this. Take care and invest smart.
Just do it! Yesterday, you said tomorrow. So just do it!